All right, guys, Target just reported they crushed on earnings, $2.05 a share versus $1.76 expected. And they beat on revenue barely, but $25.32 billion versus $25.3. It is currently 10:41 a.m. on May 17th, and Target is up $5 per share. Well, that's poop. I don't like that. I would have completely thought we were going to log in and see, because things are just completely abnormal. So, Mo, go through their earnings release and tell us some of the things they're talking about. Because I know at first, I think they also said they were a little concerned about the growing future of
the
it.
Guidance forward.
Yeah,
So comparable store sales grew 0.7%. I mean, it's not that much. Traffic grew 0.9%. I'm looking at that price reaction and going, okay, total sales grew 0.5%. And then coming down here to guidance.
One of the things I saw there.
Yeah, go ahead.
Same store comparable sales were up, offset by a decline in comparable digital sales.
Right.
That's kind of interesting.
Yeah. This is consistent with what's been going on. Strength in beauty, food, and household essentials, but mostly the beauty part. That's
so
for CVS, I think. Walgreens was the same situation.
When we were in Florida a few weeks ago, Lisa needed some sort of lipstick thing. So I was bored. I'm like, let me go out and get it. I went to CVS and Target, and they were both out of them.
Yeah.
So I had to get something comparable to it.
Beauty is still going.
Yeah.
But people spend on that.
Yeah.
Guidance. This is where my surprise comes from, that price reaction. Based on softening sales trends in the first quarter, the company is planning for a wide range of outcomes centered around low single-digit decline in comparable sales.
GAAP EPS and adjusted EPS are both expected to range from $1.30 to $1.70.
And what did they just do?
They just did 205. They just did 205. Oh. Yeah. So company full year, they're doing the same thing. 775 to 875 in EPS. Okay, so that makes it about a 20 PE for the full year. Okay, so let's look at some high level numbers here to see where we currently stand. So on the 5-year PE, we're at 18. On the 1-year PE, we're at 28. But if they do hit their full year guidance of 775 to 875, that's about a 20 PE. Is that a reasonable price for a company like Target? I don't know. I mean, it's considered like the higher end.
Walmart.
Women love Target. They love going there. It's kind of the ongoing joke about a woman goes to Target and she ends up spending, thousands of dollars or whatever. So these are things to consider when you're looking at the company. What is the appropriate multiple to pay for these companies? Because every investment is the present value of all future cash flow, as I've said till I'm blue in the face all the time. The question becomes, can they grow their revenue at a faster pace than everything else? Can they grow their profit at a faster pace than everything else? Look at their return on invested capital, Mo. That is solid.
That's very good.
14.4%. They are getting a good return on the money that's invested in the business. Mo, can you look up how many locations they have and how many when it shows year to year, how many they're opening and closing? This is an important part of when you're doing especially for retail. When you're doing an analysis on a retail location, especially in this environment when retail is becoming more digital versus physical store, you want to make sure the company isn't just opening stores in order to grow revenue and profit to satisfy investors. You still want to make sure they're getting that high return on every dollar they invest. Because think about it this way. If they invested $20 million into one store, I'm speaking hypothetically, and let's say they get a 3% return on that. Yeah, they're growing their revenue, their profit by $600,000 a year, and maybe their revenue by $20 million, but that's not a good return. That 3%, you're telling your equity holders, hey, that cash we generated from other businesses, instead of giving it to you to make 8, 9, 10% in the market, we're going to go reinvest it at a 3% return. Luckily, this 14.4% return on invested capital says that they do a good job of getting a return on the money that's in the business through debt and equity. So, do you have anything yet? 1,948 stores. Wow. Yep. What's that 244,000 thing?
That is
square feet in thousands. Yep. So 245 million square feet.
Yep.
Oh, wow.
Yeah.
Okay, so keep looking up on, look up like open.
Okay.
That's something I do.
What was that? Open 23 new stores. Now, was this for 2000?
How about closed?
Okay.
Have been
sales. Let's go here.
Disclosed. Next. Oh, there we go.
One.
So, but look at this. Go to Mo's screen real quick. This is showing year to year how things are moving here. So they closed 3 stores in 2021, closed 1 store in 2022. So one of the things I'd want you to do is figure out what is their criteria for opening stores. My guess is they're going to expanding markets in the South that have that you know, like I was in Dallas, you know, the other day. Dallas is going like this, outward and outward. As it goes more and more out, cities like Atlanta, as they go more and more out, those locations still need targets, right? And that's probably where they're going to focus their opening of stores. In more mature markets like the Northeast, it's probably more of, hey, is a store not doing well? Can we find a better location in the city? So it might be, let's close this location to reopen it over here. And these are part of the things to think about. I don't want you to overthink about these investment ideas, but these are the things to think about. So look at this, attractive dividend yield, 3.7%. It's showing a forward dividend of 2.8, so I wonder if they're cutting it. But dividends paid of 2.75 on pretty high and stable free cash flow. So they're eating up over half their free cash flow in dividends. Might not be a terrible thing. Might not be a bad thing if they can't open more stores, don't have any other use of the money. About 40, okay, not bad. All right, let's check out the 8 pillars here. 8 pillars, oh, okay. Okay, the debt thing doesn't bother me so much because there's probably a lot of leases in there, capital leases on there. So that's probably a big part of the debt. And net income is barely down, and I don't know why that is, but let's go take a look at net income.
They've had in 2021 and 22, they had big spikes.
Of what?
Income. They went from $3 billion in 2019, 2.77 billion in 2020, 6.18, 5.86 in 2022, and now 2.65.
Right, but look at it 5 years ago. 3.01. So they're lower than 2019. Ooh. Not a huge deal.
They're lower than 2000.
But guys, that's what I want you to remember. There's not much growth in EPS according to this. Let's see what analysts are saying about that, speaking of which. So analysts, of course, oh my gosh. they have EPS almost tripling in the next 4 or 5 years. Look at this growth. How's that going to happen?
I don't know. Look at the revenue growth.
Wow. Holy cow.
Yep.
Okay. So this is something to consider. We don't really take analysts with like as the Bible. They have their biases, probably even more so than ours because they have career risk. They can't deviate too far. Some people take it more seriously than we do. A lot of people think that analysts really close to the date are much more, well, yeah, because they're adjusting all the way along the way. And, you know, if you're 2 days before reporting, the company can give a lot of guidance along the way. So let's check out Stock Analyzer tool. Now, I'm going to do a 20-year analysis. Mo's going to do 10-year. And the reason I'm doing 20 years, Target is the kind of company I want to own for the long haul because it does have that dedication by its users. The female audience loves Target. There's Starbucks in Targets, right?
Yeah, CVS too.
What do you mean CVS?
They have CVS is in Target.
Oh, they do? Mm-hmm. Oh.
Yep.
Would you look at that?
Yep. I went to one when we were in West Virginia.
West Virginia?
Yep.
All right, so I'm going to do 20 years. Mo's going to do 10 years. And I want you guys to remember, this is our software. These are the tools. These are all the tools you get with our software. There's a community with thousands of people to discuss these investment ideas, including Target. $7, 7 days. Go to everythingmoney.com to sign up. $1 per day. You or your wife are going to go spend hundreds of dollars a month at Target. Just spend $1 less per day. Get the software to try it out. No brainer. It'll change the way in which you look at your investments. And especially with Stock Analyzer tool, used 1.3 million times last year. It allows you to look at a company, discount the cash flows for you to tell you what price to pay today for the company. All right, so we're going to do a quick break and then we'll be right back. All right, guys, so I did a 20-year analysis. Mo did 10. Let's go line by line. Remember, we do a low, middle, and high estimate for everything. It's going to give us a wide range the further out they are, and that's okay. Because our goal here, like I'm going to tell you right now, my high assumptions, I think they're ridiculous.
I just was shocked
I think
when I looked
but that's
over
the
there.
whole point. And the reason I do really high assumptions is if the stock is selling for a higher number than that, it shows me how overpriced the stock is.
Yeah.
Mo, what'd you do for revenue growth?
I did 1, 3, and 5.
Okay, I did 3, 5, and 7. Mo, I think inflation should be your low. Because they're not contracting sales. They're not contracting locations.
I was thinking about inflation when I did it, but I mean, let's say the next 5 years are pretty bad out there and people don't shop
That's
there.
the point, guys. You can do any sort of assumptions you want. What'd you do for profit margin?
I did 1.5, 2.5, and 3.5.
Really? I did 3, 3.75, and 4.5.
I was looking at their profit margin, and I'm just like 2.3%
for 1 year.
For 1 year, and I'm just like, well, what if it doesn't? What if things still cost a lot? What if they get back to having inventory issues?
Yeah,
all of these things.
Yeah, but I don't think it's a long term. I don't think it's a 10-year problem.
Well, I don't think that I should go higher than 3.5%.
Well, I don't disagree with you on that one. However, I sat there and said, but this is also, well, I'm very comfortable with this 3.75. I'm very comfortable with that. Okay. Free cash flow margin.
3,
Let me
4,
guess.
and 5.
1, 2, and 3.
3, 4, and 5.
Oh, okay. I did 4, 4.5, and 5. I mean, my reason being is it's such a tight window here.
4.5 all the way across.
Yeah, you could have. All right, PE.
14, 16, 18. Whoa.
I did 16, 19, 22. Here's why. High return on invested capital, brand, moat. I think Target's going to do a really good job about. Women still like to shop. I still like to shop. I still like to go pick things out. It's a good way of socializing. So that's why I look at it going, I think it justifies a higher PE.
I think my bias is running through here because I don't like Target. But let's go. Let's continue.
Why don't you like Target?
I just don't like that store. I don't
Really?
know. Yeah. I just don't like it.
I like it.
I don't.
I don't like Walmart.
I like Walmart.
Okay.
Yeah.
All right. And what'd you do for desired return?
10, 12, and 14.
Oh, I'm surprised you didn't do 15, 20, and 25.
I was going to do 100, 120, 140.
I did 10, 12, and 14. And guys, really important. My low assumptions here, I think, are so conservative. I'm okay making my 10% return over 20 years. But my high assumptions are so ridiculous, I need a larger margin of safety. And my larger margin of safety will come with a higher desired return. The more return I want, the lower the price I pay. That's the margin of safety.
I thought your high end would be a little bit higher.
Really?
Because 7% revenue growth for 20 years.
Oh, yeah. I mean, it's ridiculous, but
That's why I thought your margin of safety would be higher. But let's see.
hit the analyze button. I got a low price of 112 to 150, high price of 200 to 214, middle price of 150 to 180. So I am probably going to add it to my watch list. I mean, I could justify buying it below 150. So maybe right now I'm going to add it to my watch list at 150. But keep in mind, I mean, if I want to buy it for 150, guys, stay on this. And I want to show you guys why. So before you leave the video, I'm going to show you how I'm going to write options to get the stock at 150 and how I'm going to make money with it after Mo explains his numbers.
So I'm 45 to 90 on the low end, 126 to 180 on the high end, middle ground, 83 to 130. And here's my watch list price. It's been on there at 130. So consistent.
So Mo, can you explain to everybody what I'm going to do with this cash secured puts?
Yeah. So what Paul wants to do, and what number are you going to do? Let's call it 140.
150, 140. I'm going to do multiple ones.
Okay. So what he's going to do, he wants to be paid to wait for this. So the current price is 160. He can go in there and write a put for a future date. So he's putting the option for somebody to place those shares in his hand at a future date. So what he's going to do, go in here, write a 150 contract for, let's call it June 17th, a month from now. He's going to get some type of premium for it. Do you know what it is yet?
So June 16th right here is a month from now. And I'm looking at puts. And let's say the 150 put.
Okay.
The 150 put right here is $1.41. Okay. So go ahead, Mo.
So he's going to get $1.41 per share to sell somebody the option to put those shares in his hand if this price is lower than 150 on that date.
So I'm being paid to wait for the stock to go to the price I want. If it doesn't hit 150, I keep my $1.41 per share and I don't get the shares. If it goes below 150, I'm forced to buy it at 150, but I keep my $1.41 along the way. So my real basis is 150, the stock price I'm forced to buy it at, minus $1.41. Mm-hmm. So my real base is like 148.60. But remember, if it goes to 130, I'm still buying it for 150. So you only sell cash secured puts if you want the stock at that price. If you say, I'm buying it at 150 whenever it hits.
And the principle behind it is, let's say that this stock hit 150 today. He would be going in his account and executing a share to buy it at 150 today regardless. So it doesn't matter. So even if it drops to 130, he would have had the mindset to go and buy those shares at 150 today.
So how many days from now? It's basically $1.40. The return is $1.40 divided by 150. To make it easy, we'll call it 1%. and it's 1 month time. So to get annualized, multiplied by 12 months, I'm being paid 12% return on my cash if I do this over and over and over again to buy this stock.
Yep.
That's the whole point behind this, guys. Mo is our guy who talks about options in this community. That's another reason to join our community. Go to his section. What's it called?
Oracle's of EM.
Oracle's of
We have
EM.
an option series on it. So all of this is explained in videos.
Yep. So guys, again, everythingmoney.com, $1 per day for 7 days. Try out the software. It's well worth it. Take care.